to get into our feature here today, Theta Thursday. You know, one question we get quite often is how do we find candidates to trade credit spreads on, Matt? And, you know, with the market where it is, we could look for a bull put or a bear call or any kind of thing. But what I want you to do is stay high level for about 10 minutes and kind of just talk about scanning principles for credit spreads.
You know, in terms of credit spreads, a lot of traders who trade credit spreads, you know, after about 6 months, 8 months or whatnot, they have a list of stocks that they trade credits on, right? And that list is always going to be the same ones, the Googles, the Amazons of the world, those you know, Netflix and, you know, those types of companies, high dollar companies. We know they're very liquid. We know that we can get good credits on them and so on and so forth. But, you know, for new traders and for, you know, veteran traders alike, learning how to scan for credits can be very, very helpful in terms of finding something that you can trade right there. FinViz is my favorite scanning tool. It's also a complicated scanning tool because you have to build the scan yourself, but it is one of my favorite ones out there. First and foremost, whenever I'm scanning, whether it's for credits, debits, swing trades, cover calls, whatever it is, whatever I'm scanning for, I always start with the descriptive tab here, and I always go plus mid cap stocks. I want to make sure that we got, you know, plus mid cap. If I'm scanning for a specific, you know, dollar mark, I might go plus large cap stocks to kick out the small and the mid cap stocks for type of credit spreads. So I'm gonna stay on the plus mid just to see how many stocks I can get. Now, as you click on these in FinViz, ladies and gentlemen, you'll notice over here that it's telling you the total stocks that fit that criteria so far. And obviously our goal is to not look at 1,785 stocks. I want to get that number down to say somewhere around 20, 30, maybe 50, just to kind of get that number down as much as I can. So next I always go average volume. If I'm scanning for a stock trade, Tim, I put average volume above 500,000. If I'm going for some type of option trade, though, whether it's a directional option or whether it is a credit spread, I'm always going over $1 million, not $1 million, 1 million shares traded. And the reason is very simple. Liquidity in the options market, the percentage of companies, of low dollar companies, that is just less than the percentage of higher dollar companies with liquid options on them. So if I have, you know, over 1 million shares traded, the chances are I'm going to have a little bit more liquidity in those types of options than I would on a stock that trades, you know, say 500,000 shares a day or 700,000 shares a day. And that is important when you're talking about trading for options. And then I go over, obviously, I want it to be optionable. I'm scanning for credit spreads here. And then I want the price. And this is very important because you can do credit spreads on $20 stocks. You can do credit spreads on $50 stocks. You can do them on $100 stocks. Personally, I like higher dollar stocks because when I find a stock that is priced under $50, I usually, the first thing in my mind doesn't say, hey, let me go do a bull put spread. Again, you can. There's nothing wrong with that. I'm not trying to say that. But for my personal preference, I like those stocks in naked puts more than I do bull puts. I like those stocks in covered calls and the boomerang trade more than I do, say, in terms of just a standard bull put or a standard bear call or the combination of the iron condor. So typically I go to over $70. And as you can see, we got 265 candidates right there. Now, I skipped the fundamental tab. If I'm looking for a trade less than 30 days, I'm not going to look at a PE ratio. I'm not going to look at earnings per share growth. I'm not looking at PEG ratios. I'm not looking at forward PE ratios. Those are only for longer term investments type scenarios. I don't care about the fundamental nature of a company that I'm only going to be in a trade less than 30 days. And so I'm going to go over to the technical tab here. And the first thing I always do is I come down to the beta. And it's all right. I know I need some volatility here, right? I know I can't get a good credit on a stock that has 20% implied volatility on their options, right? I need to, in fact, if you look at it, guys, if you have 30% implied volatility on an option, that is typically right around 2% on a covered call, typically, give or take a couple percentage points. But that's practically nothing on a credit spread. Nothing on it. I mean, you can't even get the 10% of the spread typically. So what I like to look at is I like to say, okay, give me something that trades over a 1 beta here. And the reason I want something that trades over a 1 beta is that tells me that these stocks, they move faster than the market does. And if they move faster than the market does, they are typically more volatile than the market does with implied volatility. And a lot of traders will actually say, give me, over 1.5. Now, I'm not going to do that though until I start with over 1, until I start to see other filters come in here. So first thing I'm going to say, okay, are we looking at bear calls or bull puts? Because what I would click on would be different. What do you want to work on? Bear calls?
I would say based on today, well, here's the issue. Most traders are probably heavily weighted to the bull side because that's traditional trading beta. And I saw a couple of questions where, yay, how do I get my delta down? One thing you can do is naturally add bear calls. I think bear calls because most people need training on that more, I'd say.
Well, that's a good point, Tim. But and just to reiterate what you said, selling call options against the stocks you own to adjust your delta down is a very, very simple way to do that.
Yeah.
Adding bear calls is another simple way to do that. You're absolutely right. So let's go with the bear call here. So what I'm going to do is I'm going to say, okay, give me a stock that is, below, say it's 50-day moving average, right? But give me a stock that's above its 20-day moving average. And let me show you. And what you'll see here is on Illuminata, you have a bearish downtrend into a bearish retracement. And so if I go back and I forgot what their symbol was very quickly here, ILMN. Okay. So I'm looking at their chart, bearish downtrend, bearish continuation pattern. This is a inverted cup and handle, Tim. Sitting at resistance, slowing momentum with obvious resistance here at $300. That is a prime candidate, and we don't have earnings, we're post earnings here. That is a prime candidate to come out and say,
you probably get a decent credit here with 31% volatility too.
You might, maybe.
It's not going to be great. It'll be fine.
It's not going to be great, but you're not going to get any great bear call spread credit right now.
Probably not.
Market's up, what, 18%? Since the December 24th 1-day bear market, right?
Yeah.
You're not going to get a wonderful bear call spread in that environment.
No.
And I'm definitely not doing a covered stock here. So let me go down to that 16 delta, sell vertical, and you can get about
$1 on $10. So
$1 on $10, 10% on 9. So depending on how you want to categorize it, if you want to categorize your ROI based on spread, it's a 10% ROI. If you do it based on margin, buying power, that's about a 12% ROI. That's a good trade.
Give me FedEx real quick. See, what you just did with scanning obviously is very valuable, or we could just take a stock from one of the reports as well. We've already bird dogged all this stuff for you guys. Bear retracement over time. Now, here's the thing about this. You would not trade this directionally because it's not triggered yet. But can you trade a bear call without a trigger, Matt?
Of course you can.
Yeah.
Well, listen, delta systems are different than theta systems.
Yeah.
I don't need to wait for a 10% of the HER below the low of the day to sell a credit spread that's 16 delta. So no. Yeah. But another way to find, and that, FinViz, it just worked. Running the scan, we found the one that was really, really, really good there. But another way people find, bear calls specifically is they come to the options report, Tim, right? They come to the options report and they say, okay, here's my bull list. There's my bear list. A lot of times, guys, we put high dollar stocks on option reports, right? So here's ABBV, Costco, FDX, ILMN was on the report, Amazon, Take Two. And so when you're looking at this, Tim, and I'm saying, okay, on ABBV here, bearish downtrend, bearish retracement. Yeah, you can sell credit on that. Costco, I wouldn't sell a credit on that until we saw a break of 208.
It's weakness.
But it's showing weakness. FTX, there's Illuminata, Amazon, Take Two. So that's another one. Take Two would be a good bear call candidate right here too.
I think Take Two, Amazon, they both fit. By the way, you calling Illuminata just makes me
Illuminati.
Yeah,
the Illuminati. The Illuminati. All right, I've been calling them the Illuminati forever.
Conspiracy, Tim, go.
No.
No, no. Okay,
No.
but again, in using FinViz to scan, it is a very helpful way to find things. But you have to learn how to use their tools. But the best way is just use the options report picks, no doubt.
Yeah. Yeah.